The stock market is not a gambling table or a get-rich-quick scheme. It is a global financial infrastructure that allows companies to raise capital by selling ownership stakes and investors to participate in the growth of those companies. When you buy a share, you are purchasing a tiny piece of a real business, which means you are entitled to a proportional claim on its assets, earnings, and future value. Stock prices move based on supply and demand, but that demand is driven by fundamentals: revenue growth, profit margins, debt levels, management decisions, industry trends, and macroeconomic conditions. Short-term volatility is normal and often irrational, fueled by news cycles, speculation, or emotional trading, but long-term stock performance almost always reflects the underlying health and scalability of the business. Many new investors confuse price movement with value, but price is what you pay, value is what you get, and learning to distinguish between them is the first step toward intelligent investing. The market does not care about your emotions, your urgency, or your dreams. It only responds to data, behavior, and risk. Exchanges like the New York Stock Exchange or Nasdaq are not places in the traditional sense anymore. They are digital networks matching millions of buy and sell orders every second, governed by strict regulations and oversight. You do not need to understand every technical detail to start investing, but you must understand that stocks represent real companies solving real problems for real customers, and your returns will come from their ability to do that better over time. Brokers, apps, and platforms are just tools. They do not make you an investor. Your knowledge, discipline, and strategy do. Before you put a single dollar in the market, ask yourself, am I prepared to think like an owner, not a gambler? Because that mindset shift is what separates successful investors from those who lose money chasing hype. Opening a brokerage account is easier today than ever before. Most platforms allow you to sign up in under 10 minutes with just an ID, proof of address, and initial deposit. But before you click Submit, compare fees, available assets, user interface, educational resources, and customer support, because the cheapest platform is not always the best, and the fanciest app is not always the most reliable. You do not need thousands of dollars to start. Many brokers allow fractional shares, meaning you can buy $5 or $50 worth of Amazon, Google, or Apple instead of needing hundreds or thousands for a full share. Set a budget for investing that will not affect your emergency fund, rent, bills, or daily expenses. If losing that money would cause you stress, it is too much to invest right now. Automate your contributions if possible. Even $20 or $50 per week builds discipline and takes emotion out of the process. Avoid the temptation to chase hot tips or meme stocks. Those rarely end well for beginners and often lead to emotional, reactive decisions. Learn how to read a basic stock quote: price, volume, 52-week range, P/E ratio, dividend yield. These are not magic numbers, but signals that help you assess whether a stock is overvalued, undervalued, or fairly priced. Do not feel pressured to invest in individual stocks right away. Low-cost index funds or ETFs that track the S&P 500 or total market are excellent starting points because they offer instant diversification and lower risk. Keep a simple investment journal. Write down why you bought something, at what price, and what your expectations are. This will help you review your decisions later without bias. Starting small, staying consistent, and focusing on learning, not profits, in the first 6 to 12 months is the smartest strategy any beginner can adopt. Risk in investing does not mean losing everything. It means uncertainty of outcome, volatility of price, or the chance that your expectations will not be met. Every investment carries risk, even safe ones like bonds or savings accounts, because inflation can silently erode your purchasing power over time. The key is not to avoid risk, but to understand it, measure it, and manage it according to your personal goals, timeline, and tolerance for loss. Your risk tolerance is not about how much money you have. It is about how you react emotionally when your portfolio drops 10%, 20%, or 30%. If you panic sell during downturns, you are not managing risk, you are guaranteeing losses. Diversification is the most powerful risk management tool available to beginners. Spreading your money across different sectors, asset classes, geographies, and company sizes reduces your exposure to any single failure. Do not confuse volatility with risk. A stock that swings wildly is not necessarily risky. If the company is fundamentally strong and growing, it is just unpredictable in the short term. Time is your greatest ally against risk. The longer your investment horizon, the more likely you are to recover from downturns and benefit from compounding growth. Never invest money you will need within the next 3 to 5 years. Stocks are long-term instruments, and short-term needs should be kept in cash or low-volatility assets. Risk also includes behavioral factors. Overconfidence, impatience, FOMO, and herd mentality can destroy portfolios faster than any market crash. Accept that losses are part of the process. Even the best investors have losing positions. What matters is how you respond, learn, and adjust without abandoning your strategy. Fundamental analysis means evaluating a company's financial health, business model, competitive position, and growth potential, not its stock chart or social media buzz. Start with the income statement. Look at revenue growth over time, gross and net profit margins, and whether earnings per share are increasing consistently. Then check the balance sheet. How much debt does the company carry compared to its equity? Is it growing its cash reserves or burning through them? Finally, review the cash flow statement because profits can be manipulated, but cash flow shows the real money coming in and going out. Key ratios like P/E, price to earnings, P/B, price to book, and ROE, return on equity, help you compare companies within the same industry, but never use them in isolation. A low P/E might mean a stock is cheap or that the market expects its profits to collapse. A high P/E might mean it is overvalued or that investors believe in explosive future growth. Understand the company's moat. What protects it from competitors? Is it brand loyalty, patents, network effects, economies of scale, or regulatory advantages? Read the annual report, 10K, not to memorize every number, but to understand management strategy, risks they acknowledge, and how they plan to grow. Ignore short-term stock price movements when analyzing. Focus on whether the business is gaining customers, improving margins, launching successful products, or expanding into new markets. Technical analysis, studying charts and patterns, has its place, but for beginners, fundamentals are far more reliable because they are based on real business performance, not trader psychology. If you cannot explain why you own a stock in one clear sentence, based on its business, not its price, you probably should not own it. A portfolio is not a collection of random stocks you like. It is a carefully constructed system designed to meet your specific financial goals while managing risk. Start by defining your objective. Are you investing for retirement, a house, education, or passive income? Each goal requires a different time horizon, asset allocation, and risk profile. Asset allocation means dividing your money among stocks, bonds, cash, and possibly alternatives, and for beginners under 40 with long-term goals, 80 to 100% in stocks is often appropriate. Within stocks, diversify across sectors. Do not put 50% of your money in tech just because it has been hot. Balance it with healthcare, consumer staples, industrials, and financials. Consider market caps. Large-cap stocks, like Apple or Microsoft, are generally more stable. Mid-caps offer growth potential, and small caps are higher risk but can deliver higher returns. Geographic diversification matters too. While U.S. stocks dominate global markets, adding international exposure via ETFs or ADRs can reduce country-specific risk. Rebalance your portfolio at least once a year. If one sector or stock has grown to dominate your holdings, sell some to bring it back in line with your original allocation. Avoid diversification. Owning 50 stocks just for the sake of it does not reduce risk if they are all in the same industry or correlated to the same economic factors. Use low-cost index funds as your foundation. They give you broad exposure without requiring you to pick winners. Then add individual stocks only if you have done deep research and believe you have an edge. Track your portfolio's performance against a benchmark like the S&P 500, not to compete, but to understand whether your strategy is working or if adjustments are needed. Your portfolio should reflect your life. As your goals, income, or risk tolerance change, your investments should evolve too. It is not a set-and-forget system, but a living, breathing financial plan. Every trade, every fund, every platform has costs, and those costs compound over time, silently eating into your returns. Commissions may be zero on many platforms, but spreads, the difference between buy and sell prices, management fees, and expense ratios still apply. Always check them. ETFs and index funds charge annual fees called expense ratios. Even 0.10% versus 0.50% can cost you thousands over decades due to compounding. Turnover matters too. Funds that trade frequently generate capital gains distributions, which can create unexpected tax bills even if you did not sell anything. Taxes are unavoidable, but you can manage them in taxable accounts. Holding stocks for over a year qualifies you for lower long-term capital gains rates. Use tax-advantaged accounts like IRAs or 401(k)s whenever possible. They defer or eliminate taxes, letting your money grow faster. Avoid wash sales. If you sell a stock at a loss and buy it back within 30 days, the IRS disallows that loss for tax purposes. Dividends are taxed too. Qualified dividends get favorable rates, but non-qualified or foreign dividends may be taxed as ordinary income. Beware of financial advisors who earn commissions by selling you high-fee products. Always ask how they are compensated and whether they are fiduciaries, legally required to act in your best interest. Hidden traps include leverage, borrowing to invest, options trading without experience, and penny stocks. All can wipe out beginners fast. The most dangerous cost is not monetary. It is emotional. Panic selling during crashes, chasing performance after rallies, or constantly switching strategies based on headlines. Keep costs low, taxes efficient, and your behavior disciplined. That is how ordinary investors outperform professionals over time. The stock market does not test your intelligence. It tests your patience, discipline, and emotional control. Most investors fail not because they pick bad stocks, but because they let fear and greed dictate their decisions. When the market crashes, your instinct will be to sell, but history shows that the biggest gains often come in the days and weeks immediately after the worst declines. When the market soars, your instinct will be to buy more, but that is often when valuations are stretched and risk is highest. Create an investment plan and stick to it. Write down your rules for buying, selling, rebalancing, and adding money, then follow them even when emotions scream otherwise. Avoid checking your portfolio daily. Obsession with short-term fluctuations leads to impulsive decisions and unnecessary stress. Tune out financial media. Most headlines are designed to provoke reaction, not reflection, and rarely add value to long-term investors. Compare yourself only to your past self, not to friends, influencers, or hedge funds, because everyone has different goals, timelines, and risk tolerances. Accept that you will miss opportunities. No one catches every winning stock, and trying to do so leads to overtrading and mistakes. Celebrate process, not outcomes. If you did your research, stuck to your plan, and acted rationally, you succeeded even if the stock went down temporarily. Read books on behavioral finance. The Psychology of Money by Morgan Housel or Thinking Fast and Slow by Daniel Kahneman will teach you more about investing than any stock tip. The market will always be unpredictable, but your behavior does not have to be. Master your mindset and you master the game. Now that you understand the basics, your job is not to chase higher returns. It is to keep learning, stay consistent, and avoid self-sabotage. Set a quarterly review schedule, not to panic over performance, but to assess whether your goals, allocations, or risk tolerance have changed. Expand your knowledge gradually, read company reports, listen to earnings calls, follow credible analysts, not TikTok gurus, and study economic trends that affect your holdings. Consider adding new asset classes slowly, real estate via REITs, bonds, commodities, or international stocks, but only after you have mastered the fundamentals of equities. Automate everything you can, contributions, reinvesting dividends, rebalancing, so your portfolio grows even when you are busy or distracted. Build an emergency fund outside your investments, 3 to 6 months of living expenses in cash, so you never have to sell stocks in a panic during a crisis. Avoid lifestyle inflation. As your portfolio grows, resist the urge to spend more. Let compounding work its magic over decades, not months. Teach someone else what you have learned. Explaining concepts to others reinforces your own understanding and reveals gaps in your knowledge. Stay humble. The market humbles everyone eventually, no matter how much they know or how successful they have been. Ignore beating the market. For most people, matching the market's return through low-cost index funds is more than enough to build life-changing wealth over time. And finally, if you found value in this guide, hit like, subscribe, and drop a comment below with your biggest investing question. I read every one and create content based on what you need next. Investing is not about being the smartest. It is about being the most consistent, the most patient, and the most disciplined. Start small, stay steady, and let time do the heavy lifting. Your future self will thank you.